Listen, one of the easiest ways to consistently extract money from the Forex market is to master supply and demand trading. It is a lot easier to become consistently profitable, especially if you're a new trader, to keep things super simple. Look, don't overcomplicate things. Keep this super simple. Follow the exact step-by-step blueprint that I'm going to lay out for you in this video alone. And listen, if you can follow to the T every single thing I tell you in this video alone can help you become consistently profitable. So if you like the sound of that, subscribe to the channel if you haven't already, as we release videos just like this on a consistent basis. And for those of you that are already subscribed, welcome back, and let's go ahead and get started with today's lesson. So the first question we need to ask ourselves is, what is supply and demand in regards to trading Forex? Now, in any market, the entire reason the markets move up and down is simply based on the concept of supply and demand. When there is a lot of demand, the price ends up going up. When there's a lot of supply, the price ends up going down. Now, in terms of Forex specifically, these demand zones are areas where market participants are more likely to look to enter a buy or trade this asset class at this specific price point. Supply zones, supply areas are at a price where the market has exhausted and there's a lot more supply, where the traders are more willing to offload, or in other words, sell at a specific price. At these supply zones, this is where the market ends up dropping rapidly, as you see right here. So in other words, whenever you see the demand exceed the supply, it is at that moment where you will see a shift in the trend, a shift in momentum. And it is at a time where you see a shift in supply that exceeds the demand. That's when you will see the price plummeting. And again, when you see a shift in demand is exceeding the supply, that's when the price will continue to rise up. And whenever there is an excess of supply, the price will continue to go down. So the question is, why is there more demand at certain prices and why is there more supply at other prices? It's because whenever we're looking at something like this, like a currency pair, market participants are looking at a price to where the price gets low enough or reaches certain technical levels, which we'll explain later on in this lesson. When the price reaches certain levels, they feel that the price is low enough to enter a position. And not only is it low enough, but also, and the second most important point, they think it's low enough, but also the fact that they feel that the price is going to go higher, because no one wants to buy something and hold it until it continues to go lower. They buy it low in hopes that it will eventually go higher. So these demand zones are areas where smart money, smart institutional traders are seeing that the price is low enough and they feel the price is going to start increasing afterwards. So that is how these supply and demand zones are even created. And once a price reaches a point where they feel the price has gone high enough to where they're comfortable with the amount of money that they made, or they're comfortable enough of how much the exchange rate has fluctuated. So if they see that the price, for example, is at 137.69, they end up closing their trades, which creates a lot more supply. There's not as much demand at this price, so they're letting go of their positions and the distribution is now in place. And then it comes to a point where they start accumulating again, accumulating their longs, accumulating their positions, to then eventually, whenever the price has reached a conversion rate price high enough, that is where the supply exceeds the demand and the price starts going back down. And again, these zones are created, these small little sweet spots are created based on technicals and also fundamentals. If there's something that happens in the economy that creates some sort of massive shift in the economy, that will create either a supply and demand zone as well, where the supply and demand zone creates an inflection point, which creates what's called this resistance area, or in other words, this little support area right over here as well. And if you need me to explain it and give you a different analogy, let's talk about the housing market. So let's say the prices of houses are super dirt cheap. And let's say institutional money, big money, is sitting on a lot of cash and they want to buy houses. They want to use those houses as short-term rentals, long-term rentals. They want to invest and create like a portfolio. Guess what? Big money is going to swoop in, buy those houses for cheap. And the owners of the house who are looking to sell those houses see that the demand is high because, let's say, the prices of houses are low, and the demand is high because all these institutional investors are looking to buy houses. So what's going to happen is the homeowners are going to say, okay, let me go ahead and raise up the price of my house before I sell it just a little bit more. And then the institutional investors, because they feel like it's still a very cheap price and they want to buy those houses in terms of investment, they're still going to be willing to buy that house, even if the price was increased by like 10 grand on that house. And then other homeowners are seeing that same exact concept, so they go ahead and raise their prices on their house. And institutional investors are still willing to buy the house, even for $10,000, even more. And they continue to increase the price, is where you see the trend increasing higher and higher and higher and higher, because investors are still willing to purchase that asset even at a higher price because they feel it is going to go even higher. And it'll get to an inflection point. It'll get to a tipping point where the prices of the houses, which was, let's say, like a $250,000 house, is now $550,000. Investors will say, this doesn't really pencil out. This is not a wise investment for me, so I'm not really going to buy the house at this price anymore. So let's say the person who owns the house kind of really needs to get rid of it. Maybe they're not in a good financial position. They might drop the price on the house and say, you know what, instead of selling it for $550,000, I'll just sell it for $500,000. And then the price starts going back down. And now the investors come in and say, you know what, I'll buy it for you for a little bit cheaper. And as the other houses that are sitting on the market even longer and no one's willing to buy them because the prices have skyrocketed so much, they're sitting on those houses and maybe they're looking to move and maybe they're growing a family and they need to upgrade their house or whatever the case may be. The price continues to fall because these high prices aren't really penciling out. And then the owners that are sitting on the houses want to get rid of them. So they'll continue to drop the prices of the houses even more until it reaches equilibrium and then the price goes back up again. So that is supply and demand in a nutshell. So hopefully this was a good visual to help you kind of understand this concept. So how do you find the best supply and demand zones that give you the highest probability setups? The first thing we must do is we must look back in history. It's very important. Whenever you're drawing supply and demand, you want to look to the left. You always want to look back in history and find areas where the price has rejected or reacted. You want to identify areas where the price had trouble breaching. So for example, this is an area where the price struggled to go any higher. If you continue to look in the past, this is an area where the supply exceeded the demand and then the price started going back down. So investors will look at this price point. If you look on the right, it says 151.92. Investors will look at this point over here around 151.90-ish, this area. And if or whenever the price reaches this area again, what's going to happen? The investors that are in their buys, that are in their long positions, they're going to end up wanting to close their trades. And the traders who are looking to enter into the market, they're going to look at this as a resistance and they're going to enter sells. They're going to enter shorts to enter in the down direction in this exact same area as well. So you want to look at opportunities in the past where the market had created these type of rebounds. Now, there are two types of supply and demand zones you can identify, and there's two different reasons why they occur. The first reason is because traders are looking somewhere in the past, like I just mentioned. They're looking at areas where the price has reacted, and that is at a point where traders will enter what's called a pending sell limit, a sell order. Or if traders are in a buy, that is where they will close their longs. So they want to close their longs, or traders are looking to enter brand new sells. The second way supply and demand zones are created is through fundamentally driven news events. So if for whatever reason the price in the past hasn't really reacted in a certain area. So let's say, for example, here, the price, if you look to the left, this area, there's nothing really to the left that the price reacted at. So this right here was a event driven by fundamental analysis. This was the event driven by the news. This was the event that was driven by things that are happening in the economy between the US dollar and things that are happening with the Japanese yen. So you want to look at the two economies, the US, and you want to look at Japan and kind of see what's happening in that economy, because you'll notice this was a very strong bullish uptrend. And then what ended up happening from October all the way to the end of the year, the price completely shifted its sentiment, started going down. And by the way, for those of you that are brave enough to try to figure out why this trend change happened, I encourage you to go to the comments below and then type out why you feel the price has now gone down from October all the way to the end of the year. Go ahead and leave it down, a comment down in the comments below. So if you are a trader who is paying attention to technicals and fundamentals, then you have a higher probability of identifying areas where you'll see not just a temporary retracement, but an overall shift in the entire direction. So you can notice that this area lined up nicely with this, but it wasn't just like a small retracement, it was a complete change of trend. Now the trend is continued in the original direction it was already going in the past. So you can look at technicals to find your supply and demand zones, but if you include the fundamental analysis, that'll give you an idea whether that's just a small little retracement or an actual shift in the entire trend itself. So how do we draw these supply and demand zones? Now, a thing I see that's incorrect that a lot of traders do, a lot of traders, when they do their supply and demand, they usually just end up making like a single line, and they extend that line into the future in terms of their supply and demand. And let's say they have another one, they would draw another line. And let's say they found another one, they would draw another line. So they would just draw a bunch of lines on their chart to identify the supply and demand. While that is the incorrect way to do it, the right way to do it is you would go over here on the left on the trading view, you open up this rectangle tool over here. Once you have that rectangle tool selected and highlighted, the way you would kind of draw it is you want to try to attempt to encapsulate as much of the wicks as you can, and you want to try to avoid as much of the bodies as you can as well. So for example, I'm on the daily time frame right now. Before I do this top one here, let me go ahead and actually measure this from down here all the way to here. So this is around 170 pips. So in this case, I'm not going to try to encapsulate the entire wick. Instead, what I'm going to do in this particular case, because the wick is so wide, I'm just going to draw the zone towards the upper end of that wick. So that is this zone up here. Now, in terms of something like this demand zone over here would look something like this. Notice I'm trying to encapsulate as much of the wicks as I can while trying to avoid the bodies. I'm just barely grazing the bodies of the candles. The next thing you guys want to make sure that you guys always do is you want to make sure you always extend these zones into the future. Why? Because these are reference points that we're going to be using potentially in the future to enter our future trades. So if the price goes up here, this is a reference point that we're going to be looking to enter a sell in the future. So that is why we want to make sure we draw these in the future. Now this one over here, you can notice the price rejected here, price rejected here, price rejected here. So I'm going to fix this up and try to encapsulate as much of the wicks as I can while trying to avoid as much of the bodies. Look, in this scenario, yes, I did get some of the bodies in, but the reason I did it is because I wanted to try to capture as much of the wicks as I possibly can. So this is a supply zone right here. Let's go ahead and draw a couple other examples. This top one over here would be just like this. I'm going to extend that bad boy into the future. So let's do another example on GBP NZD. We're looking at this little zone over here. So what you can notice is towards the bottom area right over here, the price has trouble breaching this low, these lows over here, with this one exception, which was a flash crash. You can ignore this exception like this, but overall, the demand zone is at this price level right here, around 1.88 in this area. And what I would do actually in this scenario, I would extend this a little bit higher to encapsulate this right over here as well. Now, what you can do about this bottom wick over here, I will just go ahead and create a zone over here. Now, the reason why this zone is significant is because as the price rejected here once, The price rejected a second time, the price rejected a third time, and it's respecting this zone. So this is an area where if the price reaches this area again in the future, this would be a very strong demand zone where you can look to potentially enter a buy. That is how you would draw this zone over here. And going up to the current price action where we are right now, this zone is just capturing both of these areas right here. Capture as much of the wicks as you possibly can and try to avoid as much of the body. So this zone is right here, and this would probably be around 50 pips or so. Around 40, 50 pips is the height of this zone. Let's do another example, US oil. Now the demand zone is located right over here. How would we draw this? You want to try to capture as much of the wicks as you possibly can while trying to avoid as much of the bodies, while also still attempting to keep this as thin as possible. That is a main point I do want to stress, that you want to try to keep these zones as thin as you can. I'll explain why here in a little bit, but that is how you would draw that zone. And then you see a zone right here. This is exactly how you would draw this zone. I'm going to try to capture as much of this as I can while still trying to keep it as thin as possible, while still trying to capture as much of the peaks as I see right here. This zone is drawn just like this. And remember, you want to try to extend these all the way into the future, because these are going to be reference points of where the price might react sometime in the future. Because if the price ends up going down here, this might be an area where you want to look for a potential buy. If the price ends up going up here, this might be an area where you want to look for a potential sell. If for whatever reason the price does breach this high over here, then this would be an area where you want to look for a potential sell. Or if you were in a buy, this would be an area where you want to look to potentially close your trade. Moving on to Euro AUD. The demand zone here is located right over here, and this is exactly how you would draw it. You want to try to encapsulate as much of the wicks as you possibly can, all of the lows that you see here, and you want to try to avoid as much of the bodies as you can as well, and make sure you extend this bad boy into the future as well. Why? Because again, this is going to be a reference point that we're going to be using. And we can go to Euro CAD. We'll go to the weekly time frame over here, and we'll notice that the zone for the most recent zone is located right over here. So again, we want to try to encapsulate as much of the wicks as you possibly can while trying to avoid as much of the bodies. Yes, I had to include the bodies over here, but we just had to do it this way simply because we wanted to include all of these lows in this area right over here. How would we draw this zone over here? We would encapsulate this entire area right here. This would be the demand zone over here as well. Now, a few key points that you guys must know is, number one, make sure you make these as thin as you possibly can. Number two, make sure you try to encapsulate all the points as you possibly can. Number three, encapsulate as much of the wicks as you can while trying to avoid as much of the bodies. And number four, try to find the cleanest zones. Don't find any zones that are like super sloppy. You want to find the cleanest zones, because those are what's going to give you the highest probability setups to get the best probability trades without the trade going against you. You don't want to try to find these like secret zones and, oh, this is such an obscure zone, this is such an amazing zone that other people can't find. No, that is not how this works. You want to try to find the cleanest, most obvious zones, because those are the zones that are going to give you the greatest chance of success. So avoid any obscure or any secret magical zones that you might find that you think are going to work good. Just try to find the cleanest ones. And another main point I want to make is, usually the zones that you find on the bigger time frames, monthly, weekly, daily, these are the ones that work more often compared to the ones as you kind of go down into the lower time frames. So the monthly, weekly would work really well, because this is where the big players, the institutional money, is looking to accumulate and then distribute their money, as opposed to looking at like the 15-minute time frame, the 5-minute or the 1-minute time frame. You have to just literally ask yourself, it's common sense. Do you think big money, big players, institutional investors who have billions upon billions of dollars, do you think they're really looking to enter on a 5-minute chart for a quick little scalp? No, they're looking to capitalize on big moves because they have that much money to make. So you are in a better position following along the coattails of the institutional investors rather than following these small, quick little 5 pip, 10 pip, 15 pip trades looking on the 1-minute chart. So try to look for the zones on the bigger time frames, because they will hold much better compared to the zones on these much smaller minute sub 1 hour time frames. And the last key point I want to make is whenever you draw these, always make sure you extend them to the future. This zone is absolutely useless if you draw it just like this, because again, this could have been your reference point to enter a buy, but the fact that you ended it over here, you might not have even noticed that the price was approaching it. So you want to extend it to the future because this is going to be our reference point whenever the price does reach that area sometime in the future. So now let's talk about how do we actually enter trades using these zones. Let me kind of explain. Let's go to gold, XAU, USD. This is gold. Let's go ahead and go back to the daily time frame. And then let's go look at a zone right over here. So we have our, and by the way, if you guys look to the left, you can kind of see that the price hasn't reached this area in a long time. So this would be an area where we want to identify as our zone. So we will draw whenever the price is approaching this area and the price reacted at it. This is a point where we would go ahead and draw our zone. So this is where we want to draw our zone. And once we draw it, we want to try to encapsulate as much of the wicks. We want to try to avoid as much of the bodies. And you want to make sure, very important, you want to extend this bad boy into the future because this is going to be the reference point. So how do we enter on these zones? So let's go ahead and wait till the price approaches it a little bit. Okay, so here's what we can do. I'm going to zoom in, put this bad boy in the middle. So there are a couple ways you can trade using these zones. Here's how we would enter trades on these zones. So let's go ahead and get our buy position tool. So the first option, what you can do is you could enter a bit more aggressive trade, which would be entering a trade on the side of the zone that is closer to the price action. The price action is above the zone. So the more aggressive trade would be to enter towards the price action. A little bit more conservative trade would be to enter on the other end of the zone. And then you have a spectrum anywhere in between. So just know the closer you are to the price action, the more aggressive that trade is. The farther out you are from the price action, the more conservative that trade is. Question is, why would someone decide to do one over the other? Let me kind of explain. If you decide to go the more aggressive route, if you decide to enter your trade over here, we must understand that our stop loss must be below the zone, which is why I mentioned earlier, we want to try to keep our zones as thin as possible, because if we have a massively thick zone, guess what? That means our stop loss must also be that thick as well. In this case, this is a 350 pip stop loss on gold. I know it says 3,500, but in terms of pip, it's 350 pips. I do have a video. You can watch it above my head after this video on how to calculate pips on gold. You can watch that video. I'll link it in the description or pinned comment or even above my head over here as well. But anyways, you want to try to keep the zone as thin as you can, because this way the stop loss doesn't have to be as wide as I described. Now, if this was your trade setup, meaning your take profit was at 1661, your stop loss was at 1610, and your entry was right here, you'll notice the risk to reward ratio is around 3.2. Again, this is a more aggressive approach. The reason why someone would want to do this approach is because the aggressive approach allows the trade a higher probability of being activated, a higher chance of the trade getting triggered, higher chance of the price not leaving without you, because the farther down on that zone that you put your entry, the price might not even reach that entry, and that could just simply be a missed trade. So if you are someone who wants more trades to be activated, and if you're someone who just absolutely hates missing trades, even if you got the whole entire setup right, but you just missed a damn trade because you were off by a couple pips, then you would want to look for the more aggressive approach. But note that there is a downside to that, and that downside is the fact that you will have a lower risk to reward ratio. With all things equal, let's say you were going with a bit of a more conservative entry, meaning your entry was on the other end of the spectrum. Notice that 3 risk to reward ratio has now jumped all the way up to 9, almost 10 risk to reward ratio. Meaning if you're risking 1% of your account, if you get this trade right, this is a 1% gain on your entire account. The stop loss didn't move. The take profit didn't move because, again, these take profits and stop losses are based on technical factors that you find in the market. So in this case, stop loss, take profit didn't move. The only thing that changed was the entry. Allowed you to get a lot better risk to reward ratio. But again, the downside is if the price ends up reacting somewhere within the zone, then this is going to be a completely missed trade, a missed opportunity, and you might kick yourself in the foot later. So what you have to do is you have to find your balance, whether you are someone who is okay with missing trades, but you want a better risk to reward ratio, or if you don't want to miss trades and you're okay with a lesser risk to reward ratio, or if you are comfortable with something in between. This is for you to test, for you to see what is more comfortable for you. But anyways, let's go ahead and allow this to play out. That is our first entry. We can close that trade over here. And if you have another setup as well, we can enter the next trade in that same type of concept. And that trade got triggered as well. So that is how you trade these supply and demand zones. Now the question is this going to work 100% of the time? Absolutely not. It is our job as traders to manage our risk and create ourselves a strategy by implementing things like these to get an edge that's at least higher than 50%. If we can get better than a coin flip, and if we can have a risk to reward ratio on majority of our trades that's a higher than 1.0 risk to reward ratio, you are well beyond pretty much most every other trader out there. Listen, you don't even need to get a 70% win rate. You can even have a 50% win rate that gets you a risk to reward ratio of 1.5, something super conservative, and still be way better than most traders out there. You have to realize that 95% of traders are failing traders. 95% of traders don't make money. Only 5% of traders do make money is because they're trading with a specific strategy and they're consistently doing the same thing over and over and over and over and over again. So now, let's say, for example, that this didn't work. So let's give you an example. So over here, we have a supply zone. Yes, if you agreed, say yes. If this is a supply zone, the market reacted here once, market reacted here a second time, and then let's say you were going to enter a sell because there's no reason why we wouldn't enter this trade. We entered the trade here, first time, second time. Why would we not enter a trade here? We would if you were trading just based off of technicals alone. So if you want to enter a sell here, same exact concept, the stop loss is above it, your take profit is somewhere down here. If this was a losing trade, so be it. It's just a losing trade. It's all about probabilities. So the question is, what happens if you lose this trade? You just lost 1% of your account because that's what you're willing to risk on this trade, for example. But it is not the end of the world because what we can do, we can still make money if it breaks through this supply zone. Now what we have to look for is, since it broke through, we can look for a buy in the opposite direction of where we were just entering. So we were just entering a sell. That didn't work. So now we can look to enter a buy. Where would we look to enter a buy? At this same exact zone over here. We would look to enter a buy right over here if the price does end up reaching this area again. This supply zone can now turn into a potential demand. This is a very important concept. So just because the price pierced through it, I don't want you to get FOMO and say, oh no, the price pierced through it, the price is completely rallying up, I want to enter my buy now. That is not a wise decision, because if you enter a buy, notice that this is not an optimal area to enter your buy, because the optimal area would have been way down here. This is essentially way too late. So what you want to do is you want to wait for the price to come back to you. You want to wait for the price to come back to this zone that you've drawn, and then is when you're going to strike. So what we can do is we can enter another potential buy here, and we want to make sure that our stop loss is below the zone. Is very, very, very important. Now, if the price ends up coming back after it broke through to retest it, this is where we would strike. This is where the optimal entry would be. So let's go ahead and play this out. Trade got activated. This is our trade. And let's say we close our trade at this supply zone over here. We don't have to be too greedy. We don't have to try to reach for the moon. We close our trade right over here, collect our 499 pips, collect our 500 pips with a 4.6 risk to reward ratio. This is an extremely, extremely solid trade. If you guys can repeat this over and over and over again, you're absolutely in the money. Let's go ahead and center this and let's kind of look at the history in the back. So we see there's a zone right here. So we can go ahead and draw this out over here as well. This could be a potential area to enter a sell, a short as well, because this is a supply zone over here. Easy trade. This would have netted you around 371 pips of profit on gold. If you entered a short over here, this would have netted you around 250 pips on this red candle from here down to here. You can close your trade on this zone that we created here in the past. Price is breaching it. You want to make sure that you extend this into the future. We'll go ahead and play this out. And the price is approaching it again. So what you can do, same exact concept, enter a potential buy, stop loss below the zone, and then just continue. So in this case, it touched it, kissed it right over here. Take profit can easily be this previous zone over here. You don't have to get too greedy. Just close your trade at the zone. You don't have to reach for the moon. In this case, this was 1,463 pips. This is a massive, massive, massive trade, all in the time span of 18 days. This could be a $14,000 to $20,000 trade in 18 days. You did 1 or 2 lots. It's very, very, very simple. Now going back to USD JPY, we talked about this one in the very beginning. The reason why I didn't extend this into the future, because I wanted to show you that once you do extend into the future, notice the current price action right now, where we are right now, lines up perfectly. So if you entered a trade on this, this would be at least 100 pips profit as of just this last candle. It's like yesterday's candle, Friday's candle. So again, guys, this works all the time. You just have to look for these opportunities. Don't be afraid to enter a trade. If for some reason that you are constantly afraid of entering trades simply because you don't want to be wrong, I would suggest reduce the lot size. You don't have to trade 1% of your account. You can trade 0.1% of your account, or not even that. If you are super scared or nervous about losing money, just trade 0.01 lot size. You're not going to make any money. You're not going to lose any money. Barely a few cents that you'll make or lose, but it's not the point. It's not about making or losing money at the very beginning. It's about becoming consistently profitable. And once you are profitable, then you can slowly increase the lot size. And if for whatever reason that even with trading 0.01 lot size on a live account is still like super nerve-wracking for you, then I would suggest even after that, go ahead and trade with a demo account. Remember guys, you guys have unlimited retries on your demo account. So with that, you shouldn't have any trouble entering trades on a demo account. And until you get to a point where you're comfortable enough, you can switch to your live account and then trade with a smaller lot size. And once you see that you're still consistently profitable, then you can increase the lot size on your account with the trades. Now, this last topic I'm going to talk about is how to get the highest probability setups, how to make sure you get the highest win rate whenever you're looking to enter these supply and demand zones. The first thing, what I look for is I want to look for the next zone to be at least a minimum 100 pips, at least 100 pips of distance, where that gives me enough breathing room, what I call the playground. The playground must be at least 100 pips, because this right here is where the money is made. If you have two zones that are way too close to each other, then it's not going to be a very good trade for me. For example, so this is a zone right over here. Let's kind of measure the number of pips. It's around 300 pips. So this is very good. This is a good enough zone for me to enter a trade. That's the first thing I look for. I want to make sure that there's enough wiggle room for, if I do enter the trade, that it's going to at least give me a proper risk to reward ratio. The next thing I look for is you want to try to find different other technical factors that line up in those areas that give you what's called a confluence. Other technical factors that you can use are, number one, you can use fibs, you can use trend lines, you can use moving averages, you can use chart patterns, you can use so many different things in the market that allow you to find potential setups to enter your trades on. For example, here I've got the fib tool. I draw my fib from the lowest relative point all the way to the most recent highest relevant point, and I extend that, as always, to the future and find, does anything line up? And you'll notice that this supply and demand zone right here lines up nicely with the 50 fib. So there's two different factors that are letting me know that this right here would be a very decent area to enter a potential trade. So that is how we use confluence to increase our probability, to increase the chances of the trades going in our favor. Now, this last tip I'm going to give you is how to manage risk. So whenever you enter a trade, let's say we entered a buy position here, we have our stop loss below the zone. What I would do, whenever you get to a position where the price has went enough in your favor to where you are now profiting at least 1-to-1 risk to reward ratio, meaning my stop loss is around 75 pips. So when the price has hit around 75 pips on the upside in my direction, it is at that point where it's a wise decision to take partial profits, or in other words, take some money off of the table, and also simultaneously move your stop loss to break even, because this way you've at least secured some profit. You've guaranteed that you'll make money on the trade. And now if the price does end up going against you, you're not going to lose any money. So if the price does end up going back to break even, it's fine. You already made money. But if the price ends up going in your favor even more, guess what? You've secured half of your position. You guaranteed it. You're not going to lose any money. And then you can have your final take profit at whatever area or point that you want. That is a very smart way to ensure that your account is always consistently growing. You don't want to look for one magical Hail Mary trade. You want to do things slowly and surely, and that's what's going to allow your account to grow consistently. Okay, guys, so let's go ahead and recap everything we talked about today. Today, we talked about exactly what supply and demand is, why it works, how we can use them, how we can identify them on our actual charts, and I showed you how to find the best supply and demand zone to make sure you have the highest probability. I've even shown you exactly how to draw these supply and demand zones step by step, and I've given you very key points that you can follow to make sure you get the best zones drawn. I've even shown you how to trade the zones, where if you want more of an aggressive approach, that's going to get you a lot more trades being triggered. However, your risk to reward ratio is going to be a little bit worse, where if you want a little bit more conservative approach, you have a lot more trades being missed. But on the other end, you'll have a lot better risk to reward ratio. And I'm also even showing you what happens if your supply and demand zone is broken, where you can still make money on the opposite end. And I've shown you exactly what I do to get the highest probability setups when it comes to these zones. And that is trying to find confluences that line up with the setups that you've found. Now, guys, remember, in all of trading, it is very important, it is crucial that you try to get small incremental wins, small gains. You are not looking to get one trade that's going to completely retire you and your family. That's not how trading works. We're not gambling here. We're not trying to bet everything on black. We're trying to be here for the long run, the long term. So the longer you can stay in this game, the longer you can practice, the more time you spend on the charts, the better and better you'll get. And eventually you'll start noticing that your account size is growing to where now the lot sizes that you're entering are a little bit bigger. And the next lot sizes you're entering the next month are a little bit bigger because you have a 1% risk on a bigger account. You have a 1% risk on another bigger account, and you'll get that compounded growth. So not only will your trades be bigger, but also simply because you're getting better and better, your win rate will also be getting higher and higher. So you'll see in the beginning, yes, you might suck or it might be very hard to get a profitable account. But as you practice this more, two things are in your favor. Number one, the fact that your account is growing, that is in your favor. It's going to help your account growth get that exponential growth. The second thing that's in your favor is the fact that you're getting better and better. Your win rate will also start increasing as well. And the third thing that's going to get better is you'll start learning a lot more things about yourself. Trading will truly teach you every single thing you need to know about money. It'll teach you about yourself. It'll teach you how you mentally react to money, and whether you're super greedy with money or whether you're too scared or timid. It'll teach you a lot of things, and trading is by far the best thing anyone can do to truly understand themselves. So again, guys, don't get married to any one single trade. I see a lot of traders give up on trading, lose their accounts, completely blow their accounts simply because they don't want to use a stop loss, or they don't want to accept that trade is a losing trade, and they allow their account to get to a 20% drawdown, a 40% drawdown. Some people even blow their entire accounts, and that causes them to completely quit this industry. And it's sad to see, because there's so many different people that might have been extremely profitable. That could have been the next millionaire trader, but because they made that one stupid mistake, they just lost all hope and they've given up on their dreams. So don't be that person. Don't quit. Most people don't even realize how close they are to their breakthrough. Just do this the right way, just one time. You just have to do this right one time, and do it over and over and over and over again, and you never have to work a job in the rest of your life. If you're willing to give 1 year, 2 years, 3 years to your boss to work at a normal 9-to-5 job, why not give yourself 1, 2, 3 years to trade and learn this the right way one time? Because if you do, you just have to repeat this over and over and over again, and that is what's going to create financial freedom. That being said, I hope this training was helpful. If it was, leave a comment down below, let me know. And if you liked the video, drop a like. Obviously, it helps the channel. It helps get this video out to other traders just like you and me who want to learn, refine, or practice our craft. And if you do know a particular someone that you want to share this video with, feel free to share this link with another trader, and maybe they can get something out of it too. That being said, take care, and I'll catch you guys in the next video.